All right, today we're going to unpack a really fascinating story. It's about how Canada's biggest bank stared down what looked like a full-blown tariff crisis back in 2025 and basically didn't even blink. It's a wild ride.
So let's set the scene, right? It's early 2025. The U.S. suddenly slaps these massive new tariffs on Canadian exports, and you can just feel this chill run through the entire economy. I mean, everybody was grim. Analysts everywhere were pointing to a major downturn, a recession. It didn't just feel possible. It felt, well, pretty much inevitable.
But here's the thing. Amidst all that panic, something strange happened. Canada's financial giants, the bedrock of the whole economy, they seem to be weathering the storm just fine. So the big question is, how on earth did they pull that off?
Okay, let's dive right in. To really get why the banks were so resilient, we first have to appreciate the sheer force of the economic storm that, honestly, everyone saw coming.
And wow, did things escalate fast. First, the tariffs hit, and you had businesses scrambling to ship goods out before the deadline, which created this weird, brief, artificial surge in the economy. But that was really just the calm before the storm, because in the second quarter, bam, the cliff arrived. Exports just plummeted, GDP tanked, and unemployment shot up to nearly 7%. The crisis wasn't coming anymore, it was here.
So you've got exporters on the ropes, the economy is shrinking, naturally all eyes turn to the banks. And the consensus was pretty clear. Brace yourselves for a tariff Armageddon. The big fear was that you'd see this massive wave of businesses and regular people defaulting on their loans, shaking the entire financial system right to its core.
But then, the banks started to release their third quarter earnings reports. And the picture they painted was, well, it was completely different from the disaster everyone had been predicting.
So, the big question, did the banking sector collapse? Did that Armageddon finally show up?
Nope, not even close. The first huge surprise came down to just a single number. The banks didn't just hold steady, they actually signaled confidence. Right in the middle of this storm, they decreased the money they set aside for bad loans by 18%. Think about that. It was basically the financial world's way of saying, yeah, we're not worried.
And the analysts caught on pretty quick. As one team at Canaccord Genuity put it, the tariffs had simply hurt less than anticipated. Suddenly, all that widespread panic was starting to give way to this surprising sense of stability.
So why was that 18% drop such a big deal? Well, it all comes down to something called loan loss provisions. The easiest way to think about it is like a bank's rainy day fund, specifically for loans that might go bad. When they expect trouble on the horizon, they add more money to that fund. When they feel confident, they add less. So a drop like that, it wasn't just some small shift. It was a really bold statement that they saw clearer skies ahead.
Okay, so this brings us to the why. How is this even possible? How did the banks manage to stay so steady when so many other parts of the economy were getting hammered? Believe it or not, the single biggest reason was a fact that kinda got lost in all the panic. While all the headlines were screaming trade war, a staggering 92% of Canadian exports to the U.S. were actually exempt from the new tariffs. Yeah, 92%. The economic damage was definitely real, don't get me wrong, but it was almost surgically targeted at a much, much smaller slice of the economy than most people realized.
But it wasn't just about what didn't get hit by the tariffs. The banks had their own secret weapons too. See, when one part of their business struggled, other parts just picked up the slack. So weak loan growth? No big deal. Surging fees from wealth management more than covered it. The Canadian economy was looking a little shaky, while their super strong capital markets and the U.S. operations provided this huge financial cushion. They weren't just a simple bank. They were this diversified financial machine really built to withstand exactly this kind of shock.
And to really see just how effective these buffers were, it's super helpful to compare the banks to a company that had to face this storm head-on, with basically nowhere to hide. And wow, the difference is just so telling. For the banks, the exposure was indirect, right? It came through their borrowers. But a company like John Deere, they were on the front lines with direct exposure. They had to pay more for the raw steel that goes into every single tractor they build. And without those diverse financial buffers that the banks had, the outcome was, well, it was brutal. While the banks were signaling confidence, Deere's income just plummeted by 26%.
The real-world damage was just staggering. The tariffs ended up costing John Deere an estimated $600 million. With sales and income in a total freefall, the company was forced to lay off hundreds of workers. This right here was the tariff Armageddon everyone had been so afraid of, and it's a scenario that the banks, thanks to their diversified structure, managed to avoid completely.
So, after all that, what's the big takeaway? For anyone watching the markets, what have we really learned from this whole situation? Well, this whole episode really offers a clear playbook for investors. First off, the resilience of banks with strong U.S. operations just screams diversification. It's a huge reminder of how powerful that is. It also shows why it's so crucial to look past the scary headlines and actually monitor the key indicators, things like unemployment and export data. And look, while this particular storm has passed, it's a great reminder to always be prepared for the next round of volatility. So what's the bottom line? In a rocky environment, strength and diversification win. And for the banks, that strength is now being passed back to investors through things like share buybacks.
When you look at the big picture, the 2025 tariff crisis was really a masterclass in resilience for Canada's banks. I mean, they were tested, big time, and their diversified model held strong. They definitely dodged a bullet with this one. But it really begs the question, right? In an increasingly unpredictable global economy, what's the next storm going to look like?